to Opening Bell. We're getting you ready for the trading day. Michael Landsberg, Chief Investment Officer, Landsberg Bennett Private Wealth Management, is with me right now. And, you know, people are sort of trying to see if they feel more bullish because we're not that far off the highs, or more bearish and worried because they don't know what's happening with the Strait of Hormuz. Where do you fall on the line here?
I think that's a good point. I think a lot of the people on the market aren't really taking the concept. This may last a lot longer than people think. And I think that's my concern, is how we positioned it. Is I'd like to be wrong and this thing ends quickly, but I'd rather play it safe and make sure I've got some money set aside. You know, we took some money off the table when this first started. But I think people are kind of positioning, I think, for the idea that I hope it's going to be over really quickly. And hope's never been a really good investment strategy.
So you took some money off the table when it first started. That's about 3 weeks ago.
Yeah.
And what did you sell? When you say I took some money off the table, did you just sell S&P, or did you sell things that were sort of on the upper end and doing particularly well?
Yeah, a little bit of both. So what ended up happening was we rebalanced twice a year. So we already trimmed our allocations, luckily to a lot of the Mag 7 names. They'd done really well in 25. So we took that down. But we also looked and said, where do we want to own? And we've always been big fans of owning diversified portfolios. And so we added to some gold, some oil positions. But we also bought a little bit of a short position in the S&P just to kind of, as opposed to taking a lot more off the table. I'd rather buy a short. I don't have to generate a lot of capital gains for clients. And I can sit in that for, a week or two or a month, or how long this lasts, and then be able to go back to lower beta names.
So lower beta names. Okay, so that's the difference here. You're not, well, first of all, Mag 7 names are now often referred to as value plays. Tech overall, still everybody, comes on and says the AI frenzy, the AI revolution, the CapEx spend is all very real. I mean, what are your thoughts on tech and Mag 7 and NVIDIA, all of these names?
We so NVIDIA is still our largest holding.
Yes?
The difference is we're at 5%, not the 7.5 to 8 the S&P is. So we're chronically underweight, and we have been for a while. My belief is, if I look at kind of where they are, the Mag 7 used to trade at triple the earnings growth of the 493, and then it was double. And now they're about the same. So if I look at the other 493, the earnings growth rate's the same, but they're still trading at a 40% premium to the other 493, even after this kind of dislocation. My concern with a lot of people is, hey, the market's gone down, we want to buy more of the Mag 7. I'm like, you already own the Mag 7.
Yeah.
Let's look elsewhere. And there's a lot of AI derivative plays that you don't have to buy the Mag 7 to get other places to get diversification, and you're getting the growth rate that the Mag 7 have, but you're not paying the multiple.
And you're looking at commodities and saying folks just don't have enough meaningful allocation. And it's not just gold, right? I mean, you're looking at gold, silver, oil, food commodities. Tell us a little bit about that and what you think should be happening there.
Well, I think a lot of times what's happened in the past, we haven't had the access for individual investors to buy this without having futures and options. There's a lot of great ETFs that are out there that are, they're 1099 ETFs, not going to mess up your statements, that people can buy that give them exposure to a broad swath of the commodities. Food prices have been going up. Obviously, with oil going up, oil affects everything because it transports the food. Obviously, you got to move stuff around. Plastics, things like that are more expensive. But I think most people are under allocated to that sector, and it has proven over the past to have a good allocation. Obviously, gold had a great run last year. We don't anticipate it to have that kind of run every single year, but it's a great store of value. I think at the end of the day, most people are underestimating, and we even have underestimated how quickly inflation's turned. Originally, I thought you'd see we'd slowly, gradually get up by the end of the year. We think you might see a 3% print in March, which is April 10th reporting on CPI, up from 2.4 in February.
So you are worried about inflation.
Absolutely, and I think that's going to be a huge driver. I think that's going to also put us a damper on the amount of rate cuts we get. I think we don't get any now.
None. Okay, because I saw yesterday I was saying how Jan Hatzius over at Goldman Sachs was expecting 2 this year, and JP Morgan expected none this year, and we know that the Fed put out the dot plot with 1 this year, 1 next year. So you're in the maybe no cuts.
I think that's going to be a tough stance because obviously the president really wants cuts.
Sure.
But I think right now, how do you cut if inflation's starting to rip higher?
Right.
And we're going to look and say, boy, and again, the longer this war goes on, the more inflation's going to be a problem.
I had guests that came on and said, you're looking at the oil inflation, but then you're not looking at how it affects the economy, slows jobs, and that they should cut because of that.
Yeah, and the issue is
preemptive.
It's a tax hike to everybody that's there.
Yeah.
I mean, that's the problem, is it affects everybody.
What's interesting is your allocation in these commodities. You talked about reducing your NVIDIA allocation. Now you're around 5%, but you still want about 20% in commodities, right?
Alternatives, and I say that. So that could be commodities, it could be oil, it could be managed futures, it could be long, short. That liquid.
Where do you have the heaviest allocation?
The heaviest allocation in the alt spaces, we have one of those diversified, like a fund of funds that has a little bit of everything, a long, short, some global macro. Because realistically, at the end of the day, I'm looking for singles in that space, not for home runs. And we took our bond allocation down a few years ago. So we're at 60-40, but let's say we were 40% in that. 20% of that, we took half that bond money, realizing bonds weren't going to perform, and added it to all those other, liquid alternatives that we can get exposure to. Generate more return than bonds, because the fear with bonds, obviously, it's not going to compete with inflation.
Whatever happened to the dividend aristocrats and the good old companies that have been around 50 years, 100 years? Do you still look at those?
Absolutely.
Like what? Like what are some of your good old-time favorites?
I mean, NextEra is a favorite of mine. So NextEra is a local hometown. I live in Florida. Phenomenal story, 31 years of dividend growth, but also it's a huge play, a regulated utility in a state where everybody's moving. I mean, Florida, we got to beat people away with sticks that come down to Florida now, especially from New York. But the other thing that's interesting about...
Don't worry, Hochul's begging for them to come back. Yeah. But they're staying down there because it's beautiful.
She shoved them out. What, are they going to come back now and pay her? I don't think they're going to do that. I think the issue with NextEra is also their big AI story. They've got 20 data center negotiations going on now, maybe 40 by the end of the year. They have a huge amount of capacity. So you get kind of old school utility with new school AI. And it's a way to play the AI story that's not that frontline chip story, which I think everybody over-owns the chips.
Great chart, too. Look at that chart.
Yeah, no, it's been a great
That's
story.
been on a nice run. What about industrials? Do you like those? I mean, we talk about what's going on, and how about industrials?
Industrials, and again, depending on the industrials, I like a name like GE Vernova, and it's a name that, again, a little bit of that adjunct play on AI, but power is a problem. Making enough power is going to be a problem, and I think that's important for people to own. That's a name that we've owned for a while. One of our long-standing under-the-radar names is Comfort Systems. The ticker's FIX, F-I-X.
Oh.
They do HVAC for data centers. So again, it's a way to play this AI in the frenzy, but you're buying things that aren't in the same sector. My fear has been, and you've seen that with tech, Mag 7 peaked basically October 31 of last year. It's done nothing since it's actually down. But you get something like Comfort Systems, they're in the business of providing cooling to the data centers.
Nice chart, too. And GE Vernova, just like this chart, I mean, Comfort Systems running up there, nice chart. GE Vernova's run up, too. And yesterday we had Japan's Prime Minister, Takaichi, speaking with the U.S., and they actually made a deal. It was a $40 billion deal to build nuclear facilities here. GE Vernova and Hitachi made this joint venture to build these nuclear facilities, gas facilities. So GE Vernova is part of that, and 1 year up 175%. It's great to see you, Michael.
No, good to be here.
Thank you so much, Michael Landsberg, Landsberg Bennett Private Wealth Management.